This is a demonstration of problem 16.8b, computation of basic and diluted earnings per share. The information below pertains to Pace & Company for 2021, and the problem gives us the net income for the year. It tells us that they have 6% convertible bonds and 4% convertible cumulative preferred stock. It gives us the common stock and tells us that it is at $1 par value, gives us the tax rate for 2021, and the average market price of the common stock, which was $18 per share. The problem also states that there were no changes during 2021 in the number of common shares, preferred shares, or convertible bonds outstanding. There is also no Treasury stock. The company also has common stock options granted in a prior year to purchase 120,000 shares of common stock at $12 per share. In Part A, it states compute basic earnings per share for 2021. So to compute basic earnings per share, we start with net income, which was $8,670,000. We would need to subtract from that the preferred dividends because the preferred stock was cumulative. So to calculate the preferred dividend, we take the par value, which the problem gave us, $2,500,000, and multiply it by the 4% for the dividend rate, and we get $100,000 for the preferred dividend, and that is what we would need to subtract from net income in the numerator. We would divide that by the common shares. The problem told us that we have common stock at $1 par value, so $9,500,000 would also be equal to 9,500,000 shares. So we have basic earnings per share of 90 cents per share. Part B of the problem states compute diluted earnings per share for 2021. So I have my spreadsheet set up for it to calculate the numerator and the denominator and then show the totals up here and earnings per share. So you always start with basic earnings per share. So I'm going to put that in first. 8,670,000 minus the $100,000 preferred dividend in the numerator, and then in the denominator is the 9,500,000 shares of common. So you can see at this point we are at 90 cents basic earnings per share. Then we will test each one of the dilutive securities to determine whether or not they are dilutive or anti-dilutive. The first item we're going to start with is going to be the stock options. The stock options are dilutive. How did we know that? We know that because the market price of the common stock, which is $18 per share, is greater than the exercise price of $12 per share. So that is all the information we need to know that the stock options are dilutive. But we do need to calculate the additional shares using the Treasury stock method that would be included in the denominator for diluted earnings per share. So the Treasury stock method works this way. We take the number of stock options times the exercise price, which in this case is 120,000 options at $12, and that gives us the proceeds of $1,440,000. We divide that by $18 per share, and that gives us the number of shares that we could purchase if we used the proceeds and bought the shares in the market. And we consider that to be like the Treasury shares, the shares that we are buying. We know we would have issued 120,000 shares if all the options had been exercised. We would use the proceeds to purchase 80,000, so the additional shares that we would include in the denominator for the stock options is 40,000 shares, the difference. Next, we're going to look at the convertible bonds. The problem told us that the convertible bonds are 6% and they were issued at par, and each bond is convertible into 60 shares of common stock. So first we're going to calculate what the numerator effect would be by taking the $5 million par value and multiplying that by the 6% interest rate, which would give us $300,000 of interest per year. We would save that money, which would increase net income, if the bonds were converted. So we would determine the effect in the numerator after taxes, though, because remember, bond interest is deductible on the tax return, so if you don't have it anymore, your taxes are going to go up. So you only include in the numerator the net amount. So $300,000 of interest minus the tax effect would be $180,000 in the numerator. But we have to calculate the denominator first to determine whether or not the bonds are dilutive or anti-dilutive. Remember, we only include them if they're going to make earnings per share go down. So we would look at the number of shares that, if we convert the bonds, the additional common shares that would be issued. The face value of the bonds is $5 million. We divide that by $1,000 each to get the number of bonds. So there are 5,000 bonds outstanding. If each one of those were converted into 60 shares of common, that would mean an additional 30,000 shares would be issued. We know that 180,000 in the numerator and 300,000 shares in the denominator is going to make earnings per share go down. So that would be true. They are dilutive. They would decrease earnings per share. The last security that we need to look at is the convertible cumulative preferred stock. Remember that we always subtract cumulative preferred dividends in the numerator. However, if the cumulative preferred stock is dilutive, we would actually add that preferred dividend back, because if the preferred stock is converted, you're not going to pay that dividend. But first we have to determine, is the preferred stock dilutive or anti-dilutive? So we know that the numerator effect is 100,000, but we need to calculate the number of shares that would be issued if the convertible preferred were converted. So we take the par value that was given in the problem, $2,500,000, and the convertible preferred is $100 par value. So we divide $2,500,000 by $100, and we get the number of preferred shares, which is 25,000. Each share of preferred is convertible into 4 shares of common stock. So 25,000 times 4 is 100,000 shares of common stock. So if we divide the numerator, $100,000, which is the dividend that we would save, by the additional 100,000 common shares, we get $1 effect for the preferred stock. $1 is more than our current earnings per share of 89 cents. So that means that if the preferred stock were converted, earnings per share would go up instead of down. So the preferred stock is anti-dilutive because it would make earnings per share go up. So we have finished, and our diluted earnings per share, numerator divided by denominator that we calculated, is 89 cents instead of 90 cents. And that is the conclusion of the demonstration for problem 16-8b.